Good morning once again, options traders. Well, here's another good question for the group. Is the information baked in? And what I'm talking about is really it's an informal way of looking at what's called the efficient market theory that says that all information, or at least all that's known to the market, should be factored in or baked into the current prices. And unfortunately, I'm hearing a lot of traders getting confused with this concept, whether it's in the discussions or the comments, and they'll say things like, well, if the information is baked in, how come it's possible to make a profit? If this analyst said that the stock is going from 80 to 100, and I react on that information and I buy it, the stock price goes up and I make a profit, that shouldn't happen because that information should have been factored in. And so therefore, this whole concept of efficient markets and information being factored into prices is bogus. Well, that completely misses the point. And if you're trading on bad decisions, you're going to make bad mistakes. So what exactly does it mean when we're talking about the information is baked in? Well, once again, the basic concept is it's in there. All of the known information is factored into prices. So if information is known, that's the key word, traders will price it into the stock, the options, whatever assets that we're talking about. However, this is the kicker. Only if information is 100% certain will it be fully priced in. And see, that's rarely the case, except maybe in the case of a buyout. So yes, if you see this $80 stock that's getting bought out for 100, sure, it's going to trade for 100 right now. But that's rarely the case. Usually it's just information about what's expected to happen. And in those cases, all known information is in fact baked in. And that is certainly different from saying that the full value of what could be earned is priced in. And this is what I think that most traders are believing, this last bullet point. They'll say that if this information is known by the market, then therefore all of the potential value must be reflected today. And that is just a misunderstanding of this whole concept. So here's a way to understand why. Let's say that I offer you a game where you can win $100, but you've got to pay for it. You have to figure out the price or the value of this game. So in the markets out there, we have people that are floating around information, might be on Facebook, but people are all talking about it. What does it take to win this? And let's say that it's widely believed that I'm going to draw 10 numbers out of a hat. Now, once again, this is not what's necessarily known for sure, but it's what's believed. And that's really what information is that we see every day in the market. It's what people think. And so if this is true, or if this is what people believe, they'll say, well, you know, there's a 1 in 10 chance of winning the 100. So there's a 10% chance of collecting the $100 prize. I'm going to price this game at $10. So if you pay $10 for the game and you in fact win, yes, you're going to collect 100, tenfold on your money. So how is it possible to have made a profit if this information was factored in? Well, this is the key right here. The probability was factored in. Of the known information up here, this is where it got factored in. And so yes, that part was factored into the price at $10, but it doesn't mean that the entire $100 value got factored in because it wasn't 100% certain. It was only 10% certain. Now, on the other hand, let's say that new information hits the market and people are saying, well, we now believe that it's going to be a coin flip. That's what's going to determine the payoff of this game. And if that's true, or what people believe, then they're going to say, well, you know, it's no longer a 10% chance of winning. It is a 50% chance of winning the $100. And now I'm going to increase the price of this game from $10 to $50. And even if you pay $50 and you win, yes, you're going to collect $100. You'll double your money. So again, it doesn't mean that you can't make a profit. It just means that this information up here is factored in down here. They're factoring in the probabilities of collecting this very high reward. But once again, a lot of times traders misinterpret that, and they just, for some reason, seem to think that the full value of what could be earned is what should be reflected in the market. So why is this a problem? Why is this view going to cause so many problems? Well, there's a lot of reasons why it can, but here's a couple that come to mind. First, if you're buying options with high implied volatility, it doesn't mean you can't make a profit. And a lot of times you'll hear traders who will say that, well, this option's trading at high implied volatility, and so therefore you're not going to make a profit. Not true. The high implied volatility simply means that traders are putting a high price on that information, and high implied volatility can certainly go much higher. Just ask anybody who shorted GameStop when it was in the 50s or 60s. It can always go a lot higher. We're just saying that this high IV compared to historic implied volatilities seems to be on the high side. And yes, all things being equal, it is a concern, but it's not saying that that is the full value of that option. And then in a related way, conversely, if you're selling options with high IV, especially if that's the only reason that you're selling them, it doesn't mean that you have a high chance for profit. So the flip side is traders say, oh, this option's trading at this very historically high implied volatility, so just sell the heck out of them and you've got a very high chance of making money. Not necessarily true. The market is just saying, based on the information that we know, we are putting a very high price on this. And again, highs can go higher. So you need to understand that information being baked in means the value of the information is accounted for, but it doesn't mean that the full potential future value is accounted for. Yes, we might know what that future potential value is, but that doesn't mean that we have to realize that full value today. We're just trying to say, based on what we know, what is that information worth? And so if you keep those points in mind, it will keep you out of a lot of bad decisions and give you better chances for success. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.